Well, financials have been lagging the overall market all year. When you look at the S&P 500, it's up on the year, and the KBW Bank Index is actually down for the year. So financials have been lagging. I think most of that has to do with the yield curve and the fact that it has been flattening substantially. When you look at what the 2-10 spread was just a month ago, it was almost double where we are today. The other thing that's really impacting that you see where you see the financials being impacted is look at the small cap index. The majority, the biggest constituent group in the Russell 2000 are financials. Wells Fargo, as a big mega cap bank, would most closely match the businesses of a lot of those financial companies in the Russell 2000. That's why you're seeing that index lag. And I think that's important to the overall health of the market when you look at it. The Russell 2000, I think, holds the key to where we go from here. If we can get back to the all-time high around 1706, 1708 on an intraday basis and break through that, then we have more room to run in this market. But Sarah, you're absolutely right. Financials hold the key in aggregate and certainly in the Russell 2000.
Rick, Wedell, you know, what Keith's mentioning here about concern over the yield curve, the shape of the yield curve, and the fact that banks are underperforming, that normally in other market environments would have people sort of wake up and say, wait a second, are they trying to tell us that the markets as a whole are perhaps on some thin ice? But yet all the other inputs that you look at, obviously earnings growth and all the fundamentals, don't really tell that story. So where do you come down?
I think that's right, Michael. And I think if you look at the underlying drivers of the U.S. economy is in a very, very good place right now. Certainly the yield curve is an area of concern for financials, but you know, you're looking at a second quarter GDP print that's expected between 3.8, 3.9%. That's pretty phenomenal growth. And if you look at earnings growth for the S&P 500, you're looking at high 20s. So I think that it's a very conducive environment for the vast majority of sectors of the S&P 500. I think the financials have a particular problem associated with them, associated with the yield curve, particularly the larger cap financials. If you look at some of the smaller cap financials that are more domestically focused, they haven't had as tough a time with it over the course of the year. And so I really do think that we remain pretty bullish on equities coming into the second quarter earnings season. I think investor sentiment coming into the second quarter has been a little bit on the negative side, which should be supportive of potentially rewarding companies that outperform. And I think from a valuation standpoint, if you look at where the S&P 500 is, trading at about 16 times forward, that's in line with this 25-year average and slightly below where we've been for the past 4 or 5 years. So I think it's actually a pretty bullish environment for equities overall.
Rick Santelli, you listened to Jamie Dimon on the call saying the economy is good, especially in the U.S. and those trade fears, they're affecting psyches, but not necessarily the economics at this point. So what is the bond market telling us?
I think the bond market is telling us a mixed message. I think the long end is telling us that global growth and the central bank subsidies, I think both those have to be studied. I think other economies like Europe and China are in the box to some extent. I think there's a 50 to 75 basis point subsidy in our long end, not only based on our Fed, which is trying to normalize, but based on the activities of other central banks and the fact they failed to normalize. This week, we're basically unchanged to up a basis point in tens, but we're up 4 basis point in twos. It goes right along with what Rick was talking about regarding the flat yield curve and maybe how that's a transmission into the message of why some of the financials are weak. Generically, I think the 2-year is your best gauge to pay attention to, almost as an economic indicator. And if you overlay a 2-year note on top of the S&P since June, it tracked pretty tight, which leads me to my next point. Listen, Rick and Keith are watching the minutiae in equities a lot more closely than I am, but I love weekly closes. And today's weekly close in the S&P, as long as it's above 2786, that was a June high. To me, it's breakout country. I think that the S&Ps are going to lead the way to some extent next week. We are now at the highest levels on a closing basis since 1st of February, end of January. And when I look at 2-year notes and I look at the S&Ps, I think I'm certainly glad I'm not Jay Powell.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.